Welcome to our deep dive. Today we're exploring something really vital for, well, basically the whole global economy. It's about that delicate balance between trust, security, and keeping innovation going in the payments world. We're looking at how a solid, proactive risk management framework isn't just about, compliance. It's actually a strategic tool for growth. We've got a really interesting blueprint here from Mastercard to look at, and we'll explore how you can adapt it for your own due diligence, your own investigations.
Yeah, and what's fascinating, I think, is how these network rules things people often see as just external hoops to jump through can actually become a really powerful internal guide. It's kind of a shortcut, isn't it, to figuring out what really protects you in the long run. Moves beyond just ticking boxes.
That's a great way to put it, internalizing those rules.
Yeah.
Okay, so let's unpack this blueprint. Mastercard's global compliance programs. And like you said, these aren't just rules for, the massive banks. They offer really clear metrics that anyone can potentially use.
Exactly. We're talking about things like the excessive chargeback program, the ECP, and the excessive fraud merchant program, or EFM. So the EFM program, for instance, it flags merchants if their fraud to sales ratio hits 50 basis points.
Which is 0.5%.
Right, 0.5% or higher. And there are other criteria, too, like maybe they're not using 3D Secure very much.
Okay, so here's where it gets really interesting for, say, an acquirer or a platform. You don't have to actually wait for Mastercard to flag a problem at that 50 basis point level.
No, absolutely not.
You could set your own internal threshold much lower, maybe 25 or 30 basis points as a kind of early warning.
That's precisely the proactive approach. You set a more conservative internal KRI, a key risk indicator. It lets you spot and address potential fraud issues way before they blow up into major liabilities or, trigger those network penalties.
So you're ahead of the game.
Exactly. Predictive, not just reactive. And you see this reinforced in things like the BRAM program, too, business risk assessment and mitigation. It really highlights that acquirers are that first line of defense, and it encourages proactive monitoring, maybe using tools like an MMSP, a merchant monitoring service provider.
Right, incentives for being proactive. Okay, so carrying that idea forward, that proactive defense, let's zoom out a bit. We have these Mastercard metrics for general monitoring, but when do you need to go deeper? That's where enhanced due diligence, EDD, fits in, right?
That's it. EDD isn't for every single merchant, obviously. It's really reserved for those higher risk relationships, which brings up the key question. What actually triggers an EDD review for you?
Okay, what are some examples?
Well, think about specific risk factors. Maybe it's geographic risk, certain countries or regions, or particular business models like, say, cryptocurrency exchanges. Or perhaps there's a PP involved, a politically exposed person. Those are definite signals for needing a closer look.
Got it. So to manage these more complex risks, you really need structure. How do you organize that?
Yeah, structure's key. The 3 lines of defense model is pretty standard and effective here.
Okay, break that down for us.
So your first line is your business operations team. They handle the initial onboarding, the basic due diligence.
Standard checks.
Right. Then the second line, that's your specialized EDD team. These are the folks who do the deep dive investigations when those triggers hit.
And your investigators.
Your investigators, exactly. And then the third line is internal audit. They provide that independent oversight, making sure the whole process is working, that it's robust, it's compliant.
Makes sense. And the tech needed for this, it sounds like it needs to be pretty sophisticated.
Oh, absolutely. The technology stack is, well, it's pretty much non-negotiable today. Modern EDD really relies on multi-layered identity verification. We're talking biometric facial recognition.
Okay.
But crucially, combined with liveness detection, that's key to stopping sophisticated spoofing attacks.
Right, proving it's a real person, live.
Exactly. And then you add AI-powered tools on top of that, behavioral analytics, graph analytics. These can uncover hidden connections, fraud rings, stuff that's really hard for a human analyst to spot alone.
Let's take a real-world case. Flutterwave. They operate across Africa, which is obviously a huge opportunity, but also presents unique risks, right?
Definitely. High risk, high reward is a good way to put it. You look at markets like Nigeria, Kenya, identity theft is a massive problem. Reports suggest it accounts for something like, 63% of digital financial crime.
Wow, 63%, that's huge.
It is, and it's made worse by sometimes weaker digital ID systems locally, which makes things like biometric spoofing a very real, very present danger.
So Flutterwave, they've done a lot already, right? They've secured tough licenses, hired good risk people.
They have a strong foundation, no question. But to get to that truly world-class EDD level, especially given that context, They really need to formalize a data-driven risk scoring model. And that means using those Mastercard metrics we talked about, like the EFM thresholds.
But using them internally.
Yes, using them as internal benchmarks, maybe aiming for that lower, say 25 basis point fraud ratio internally as a target or a trigger.
So practically speaking, what does that look like for them on the ground? What kind of tech stack?
It has to be tailored, an Africa-specific stack.
Meaning
Multi-layered identity verification that specifically knows how to cross-reference with local government ID databases where possible. Combining strong biometrics with that liveness detection piece we mentioned, and really leaning into behavioral analytics tuned to local patterns.
So it's about adapting the global best practices to the specific regional threats and vulnerabilities they face every day, tackling that 63% problem head-on.
Precisely. It's tailoring the solution. Because ultimately, for any payment gateway, anywhere in the world, it's integrity. That's its most valuable currency. By taking this proactive, quantitative approach, using those internal benchmarks, investing smartly in the right, tailored technology, and having clear governance, you really do shift risk management. It stops being just a burden, a cost center, and it becomes a core strength, maybe even a competitive advantage.
Yeah, absolutely. This whole deep dive really underscores that the future of commerce, it isn't just about flashy innovation. It's fundamentally built on enduring trust. So the question for you listening is, what opportunities could you unlock if your risk framework wasn't just compliant, but became a powerful differentiator, something that signaled absolute trustworthiness to everyone you work with, partners, regulators, and especially your customers?